Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into CoreWeave Inc., CRWV, an entity that has, well, really redefined what it means to be a hyperscaler in the age of generative AI.
It really has. CoreWeave is a speculative AI hyperscaler betting its $55 billion contracted backlog and NVIDIA-backed security will drive a high-velocity build-out, despite $18.8 billion in total debt and severe 67% customer concentration risk from Microsoft.
That thesis just sets up the core conflict of this deep dive perfectly. I mean, we are examining a company that is essentially running an unprecedented capital expenditure race.
A sprint, really.
Right, a sprint challenging established multi-trillion-dollar companies like Amazon and Google. So our mission here is to dissect the unique combination of financial engineering and technical superiority that allows CoreWeave to scale at this speed.
And in a market that's perpetually constrained by chip and data center supply. That's the key.
Exactly. We need to understand not just what they are building, but how they are financing a build-out of this magnitude.
Precisely. When you look at CoreWeave, you are looking at an entity that is just. It's engineered for acceleration. Their financial model is unlike anything we've really seen in enterprise infrastructure.
Okay, so where do we start to unravel that?
To really grasp their strategy, we have to jump straight into their Q3 2025 financial results. They tell a story of breathtaking operational success, but it's immediately offset by these astronomical capital costs.
Which is the nature of hyperscaling, right?
It's the name of the game.
Okay, so let's unpack that top-line performance first. The sheer growth rate alone is staggering, and it validates the immense demand for their specialized service.
It does. So CoreWeave's revenue in Q3 2025, it hit $1.36 billion.
$1.36 billion in a single quarter.
In one quarter. And this is not just a large number. It represents a significant 134% year-over-year growth rate.
134%.
This velocity, it just proves that the customer base, and we're talking about the biggest names in AI, they are willing and eager to transition to this specialized infrastructure. For the 9-month total, they've already crossed the $3.56 billion mark.
So the market is voting with its wallet every single day.
The market is validating their business model daily.
What's crucial to me, though, is that this demand isn't just volume, it's high-margin volume. When we talk about CoreWeave's financial health, we have to look past the statutory accounting to really understand the underlying unit economics.
And that's where the analysis gets fascinating. Their unit economics are exceptionally robust. So CoreWeave reported adjusted EBITDA of $838 million for Q3 alone.
$838 million. Okay, and that translates into what kind of margin?
That translates directly into a robust 61% margin, a figure that more than doubled year over year.
61%. That's software-level margin on a hardware business.
It's incredible. And if you dig further, adjusted operating income was $217 million. So that sustains a solid 16% margin. Management attributed this profitability to two key factors: higher realized revenue and significantly improved fleet efficiencies.
Meaning they're getting more work out of their already deployed infrastructure.
Exactly. More bang for their buck.
But the shadow over that operating income, as always with hyperscalers, is the true cost of growth. Can you remind us of the GAAP reality? Because for all this success, they are still reporting a substantial loss.
Precisely. You have to contrast that adjusted profitability with the GAAP reality, the generally accepted accounting principles, which reported a $110 million net loss for the quarter.
And that's the cost of buying the future.
It's the immediate, unavoidable cost. It's driven primarily by two massive non-cash expenditures, massive depreciation as they purchase billions in GPUs and infrastructure, and then significant stock-based compensation, which is pretty typical for a rapidly expanding, highly technical workforce.
So if they're spending nearly $2 billion a quarter on CapEx and running a GAAP loss, the only way to track the true pace of their physical growth is to look at their balance sheet.
Right.
Specifically, that construction in progress line, that number tells a story of physical commitment.
It screams commitment. Q3 capital expenditure was $1.9 billion. This was actually slightly lower than management anticipated, which they attributed to specific localized delays related to a single third-party data center provider.
Which is a critical reminder of the execution risks here.
A huge reminder. It's all about supply chain bottlenecks. But the intent to build, That's captured in the skyrocketing construction progress, or CIP, line item.
And what does that CIP figure actually represent? We saw it jump exponentially.
Construction in progress increased by $2.8 billion quarter over quarter, reaching a colossal $6.9 billion as of September 30, 2025.
6.9 billion.
You should think of this $6.9 billion as high-value inventory. It's infrastructure, fully purchased servers, racks, networking equipment, GPUs, that is just sitting there, fully paid for, waiting.
Waiting for what?
Waiting for the delivery and commissioning of the powered shells. The powered shell is the data center building itself, complete with basic power distribution and cooling, but lacking the specialized compute equipment.
So the CIP figure confirms they have the chips and the hardware. The bottleneck is now hard real estate and power delivery.
That's it, exactly.
That perfectly sets up the massive financing challenge. You cannot carry $6.9 billion in inventory and spend $1.9 billion in a quarter without an incredibly sophisticated and aggressive financing engine.
Not without collapsing, no.
So how are they funding this build-out without collapsing under the weight of the debt?
They're essentially applying Wall Street financial engineering to Silicon Valley hardware deployment. As of Q3 2025, the company had $14 billion in total indebtedness.
$14 billion. Yet they successfully secured another $14 billion in new debt and equity just year to date. This is fueled by their core insight that a highly predictable, long-term contracted revenue stream is an asset that can be securitized.
Let's delve into that financial superpower. They use sophisticated debt structures, asset-backed facilities, and special-purpose vehicles, or SPVs. For you, the listener, what is the practical impact of using an SPV to fund a server purchase?
This is the genius move. A special-purpose vehicle is a legal entity created solely to hold a specific asset, say 10,000 H100 GPUs, and their corresponding contract with a major AI lab and its associated liability, which is the debt used to buy those GPUs.
So the debt is siloed.
The debt is non-recourse to CoreWeave's core operations. It's amortized within the four walls of the customer contract.
So if they sign a 7-year, $5 billion contract with a Fortune 50 company, they can take that contract to a bank, say, fund this specific $4 billion build-out using an SPV, and the debt automatically retires itself through the committed revenue payments. Precisely. The debt markets, as the CEO correctly noted, are focused on risk mitigation. Do not lose my money. By having guaranteed committed revenue from investment-grade customers, CoreWeave can underwrite the financing at far more favorable rates than if they were simply funding general corporate purposes.
And this financial structure allows them to fund their operational scale.
Exactly. We're talking 2.9 gigawatts of total contracted power capacity, set to come online over the next 12 to 24 months. The financing innovation is what enables the massive physical build-out.
It's a compelling model, but it only works if the product is superior enough to warrant those multi-year, multi-billion-dollar contracts.
Absolutely.
So let's pivot now to the core technology and competitive moat. CoreWeave calls itself AI native. Why does legacy cloud infrastructure built by the trillion-dollar giants fundamentally fail the test when it comes to modern AI workloads?
The difference is architectural destiny. Legacy cloud infrastructure, which came of age in the 2000s and 2010s, was optimized for general-purpose computing.
So think CPU-based architectures built for running websites, storing data, that sort of thing.
Exactly. Running host websites, storing data lakes, transactional databases, general SaaS applications. These all rely on fixed logic calculations.
That is sequential and generalized. AI, however, requires something entirely different.
Entirely. AI workloads, specifically training large language models, require massive parallelization for matrix-based calculations. These calculations demand thousands of GPUs working simultaneously, communicating instantly.
And the old systems can't handle that chatter.
General-purpose cloud networking, which often relies on standard Ethernet, introduces latency and communication bottlenecks that severely throttle performance when running massive parallel tasks. CoreWeave is purpose-built to eliminate these bottlenecks.
So how does that purpose-built architecture translate into measurable performance gains for the customer? Give us the hard numbers that lock in those contracts.
The gains are substantial. Because their infrastructure is optimized specifically for AI, they can deliver up to 25% higher TFLOPS per GPU compared to generalized environments.
And TFLOPS is?
TFOOPS, or trillion floating point operations per second. It's the raw measure of computational power. But more critically, they achieve approximately 20% higher model FLOPS utilization, or MFU.
MFU. Now that's the metric that AI customers truly care about, isn't it?
It is. It measures how efficiently the model uses the available hardware. They're getting better utilization in raw power because the entire system, hardware, networking, and software, is custom built to maximize parallelism.
So the customer saves money because they can train their model faster or use fewer cycles to get the same result.
That's the bottom line.
What are the specific technical ingredients that deliver this technical moat?
There are three main components. First, the infrastructure uses bare metal nodes. There's no virtualization layer overhead typical of traditional multi-tenant cloud environments. The customer gets direct access to the hardware.
No middleman.
No software middleman. Second, they utilize advanced networking, specifically NVIDIA InfiniBand, which is necessary for high-speed, low-latency communication between GPUs within a cluster. Traditional hyperscalers often lack this ubiquitous high-speed fabric.
And the third component moves us beyond just physical hardware and into the software layer, right?
Absolutely. The third is a proprietary software stack. This includes mandatory features like liquid cooling for servers, which lets them run the chips at higher performance levels without overheating. And crucially, it includes their software tools for management and deployment.
This brings us to their strategic acquisition of Weights and Biases for $1 billion. This wasn't just a customer grab, it was a fundamental enhancement of their software moat.
That acquisition was incredibly strategic. It immediately added 1,600 direct customer relationships, often the most sophisticated ML teams in the world, and integrated their proprietary monitoring and management tools directly into CoreWeave's infrastructure.
And the key proprietary feature is the mission control integration.
Yes, mission control.
So explain the impact of mission control on the developer. Why does this matter beyond just a nice dashboard?
Mission control gives customers critical infrastructure visibility that is simply unavailable from generalized clouds. In traditional environments, if your training run stalls, you have to contact the cloud provider, submit a ticket, and just wait.
And time is money when you're renting this kind of hardware.
Exactly. With Mission Control, CoreWeave customers can detect and respond to issues faster, potentially identifying faulty nodes or bottlenecks in real time. This increases efficiency, accelerates the development cycle, and dramatically reduces dead time for billion-dollar hardware investments.
Moving from the technical to the economic moat, we need to discuss the single biggest pain point they solve for large-scale customers: egress fees.
This is perhaps the most visible economic differentiator. It solves a major frustration imposed by competitors. CoreWeave offers zero egress fees.
And for those who don't know, egress fees are what you pay to take your data out of a cloud.
Right. When AI companies train massive models, they move petabytes of data in, data out, data between regions. Traditional hyperscalers charge substantial fees for customers moving data out of their ecosystem, effectively creating a financial lock-in.
A customer gets penalized for wanting to move their data or change platforms.
That's it. For a major AI lab, this can amount to tens of millions of dollars annually. It often makes a migration impossible.
So by eliminating this charge, CoreWeave provides a massive financial incentive to onboard.
A massive one. Furthermore, they introduced the Zero Egress Migration, or Zero EM program, where they actively help customers migrate massive data sets and, in some cases, cut customer storage costs by 75% once they're fully transitioned to CoreWeave.
That's a powerful 1-2 punch. Superior technical performance and vastly superior economic terms. It explains how they lock in that massive contracted backlog.
It's a huge part of it.
Now, let's discuss the critical safety net that underwrites this entire operation: their relationship with NVIDIA. This is more than a supplier arrangement. It's a strategic partnership.
It is the linchpin of their financial stability. CoreWeave acts as an essential partner to NVIDIA, often being the first to offer advanced hardware solutions to the market.
Like the new Blackwell chips.
Exactly. This includes the cutting-edge NVIDIA GB200 and VL72 and NVIDIA HGX B200 platforms. This first-to-market advantage is crucial because in a chronically undersupplied GPU market, access to the latest generation hardware is the primary determinant of who wins those massive AI contracts.
So they don't just buy chips, they co-develop and showcase the technology's potential.
Absolutely. We saw proof of this collaboration in June 2025 when CoreWeave, working with NVIDIA and IBM, submitted the largest ever MLPerf training benchmark.
I remember that.
They used nearly 2,500 NVIDIA GB200 Grace Blackwell superchips, and they demonstrated the ability to solve the Llama 3.1405B model in just over 27 minutes.
Which is a performance benchmark that reassures potential customers that CoreWeave can handle the largest, most demanding training runs instantly.
It's the ultimate proof point.
Let's address the elephant in the room regarding multi-billion-dollar infrastructure debt. Utilization risk. This is the fear that you build a data center, fill it with expensive GPUs, and then struggle to find tenants.
The classic build it and they will come risk.
Right, and the NVIDIA relationship fundamentally eliminates this specific financial risk. How does that mechanism work?
This is the genius of the financial structure. NVIDIA holds a reported 7% ownership stake in CoreWeave, which cements their strategic alignment. But the core financial de-risking comes from the $6.3 billion Master Services Agreement, the MSA.
And this is not just a purchase agreement.
No, it's a capacity agreement.
Okay, so explain the obligation side of the MSA for the listener.
The MSA allows CoreWeave to offer capacity that's technically reserved under the NVIDIA agreement to smaller, fast-growing customers who might prefer shorter commitment terms. That flexibility is great for business.
But what's the backstop?
The core benefit is that NVIDIA is obligated to purchase any unsold capacity through 2032. This acts as a guaranteed revenue stream for CoreWeave's infrastructure investments.
So if CoreWeave builds a $3 billion data center and only manages to sell $2 billion worth of capacity to Meta and OpenAI, NVIDIA steps in and purchases the remaining $1 billion in capacity.
That's precisely right. This guaranteed revenue stream fundamentally eliminates utilization risk for CoreWeave's huge debt-fueled infrastructure investments.
It's an insurance policy.
It's an insurance policy built into the relationship, and that significantly reduces the perceived risk for the financial institutions providing the debt, allowing CoreWeave to borrow more cheaply and quickly.
Another constant investor concern in the chip race is obsolescence. If I'm investing in Hoppers today, will they be worthless when Blackwell is fully deployed tomorrow? How does CoreWeave ensure its fleet maintains its residual value?
Well, the current environment is just chronically undersupplied. That means demand transcends GPU generations. We are seeing continued, robust use cases for older architectures, Ampers, Hoppers, and soon, early Blackwells. The utility of these chips is sustained because the market has not yet reached saturation at any level of compute.
Do we have a concrete example of this residual value in action?
Yes. Management cited a compelling anecdote in Q3. A customer with a significant contract for over 10,000 H100s, which was nearing its expiration date, proactively reached out.
And they wanted to renew.
They recontracted the capacity 2 quarters early. And the most striking part, the new early renewal was executed at a price within 5% of the original agreement.
That is a powerful data point. A mere 5% price haircut after several years of service shows the immense sustained demand. It proves the long-term economic utility of their platform.
It does. And this sustainability is further supported by the shifting AI workload mix. We're moving beyond the heavy initial investment in training large models and into the operational phase.
Inference. Training versus inference. How does this shift safeguard CoreWeave's investment?
Training is highly demanding. It requires the absolute latest chips, like Blackwell's, to be economical. Inference, which is the act of running the model to generate text or images, is less computationally intensive per query, but it must be done at massive scale.
And the older chips are good enough for that.
They're perfect for it.
Yep.
Management noted that inference now accounts for over 50% of AI workloads in their portfolio. Older GPUs, like Hoppers or even advanced Amperes, are perfectly suited and highly efficient for serving these inference demands.
Which ensures they maintain their economic viability for years after their training usefulness starts to wane.
Exactly.
That brings us to the ultimate metric of their success, the immense volume of their contracted demand. Let's quantify the massive forward visibility CoreWeave has locked in.
The sheer scale of their forward demand is a primary argument for their valuation. CoreWeave's total contracted revenue backlog exceeded a staggering $55 billion by the end of Q3 2025.
$55 billion. I mean, let that number sink in for a moment.
It's not just organic growth, it's explosive velocity. They added over $25 billion in revenue backlog during that single quarter alone.
So that's future revenue locked down. We also need to define the related accounting term, remaining performance obligations, or RPO.
Right, RPO is the measure of contracted revenue that has not yet been recognized. Their RPO reached $50 billion, which the CEO proudly stated was achieved faster than any cloud in history.
And what's the conversion rate? How quickly does that become real money?
That's what truly validates the short-term financing strategy. A massive 40% of this $55 billion backlog is expected to convert to realized revenue within 24 months.
So within 2 years.
Within 2 years. That certainty allows them to finance infrastructure builds today, knowing the amortization schedule is imminent.
This immense backlog naturally introduces the question of customer concentration. The opening thesis cited a severe 67% customer concentration risk from Microsoft specifically, even though the latest reported figure is much lower. We need to detail the diversification journey and how they are mitigating this structural risk.
You hit on the most critical structural risk they face, and it's one they're actively managing. CoreWeave's initial hypergrowth relied heavily on a small handful of anchor tenants. Microsoft was key to their early capacity deployment, which at one point contributed to that reported 67% concentration.
And that kind of reliance on any single customer is an enormous risk when you're dealing with $18 billion in debt.
It's huge.
So how are they diversifying away from that early structural risk?
They are adding massive diversified commitments. The backlog now includes huge multi-year contracts, $14.2 billion from Meta Platforms, which extends through 2031,
$14.2 billion from Meta,
and $22.4 billion from OpenAI, extending through 2030. These contracts are the engine of diversification.
So what does that mean for the current concentration figures? Has that 67% number come down?
It means crucial diversification progress. The share of contracted revenue backlog from any single customer, whether it's Microsoft, Meta, or OpenAI, has dropped significantly year to date. It fell from 85% at the beginning of 2025 down to approximately 35% by the end of Q3.
So they've cut it by more than half in less than a year.
It's a massive risk mitigation achievement. Furthermore, the quality of this demand underwrites the financing model. More than 60% of the revenue backlog is now tied to investment-grade customers.
That investment-grade backing is the financial lubricant. Now let's return to the operational constraints we identified earlier. If CoreWeave has the demand, the chips via NVIDIA, and the financing via SPVs, what remains the limiting factor for realizing that $55 billion backlog?
The limiting factor remains the physical space, the supply of powered shells or data center facilities. The CEO has repeatedly emphasized that the market is losing ground. Shell availability is the bottleneck, not GPU supply or debt capital.
The construction industry simply can't keep up.
They can't deliver high-power density data centers fast enough to keep pace with AI demand.
So if you are bottlenecked by a third-party supply chain, the only solution is to vertically integrate and take control of that supply yourself.
That is the strategic response. CoreWeave is accelerating vertical integration and initiating massive self-build data center projects. This move allows them to control capacity delivery, mitigate the third-party execution risks we saw in the Q3 CapEx delays, and really de-risk their build-out portfolio.
Give us the prime example of this vertical integration strategy.
Look at the commitment in Lancaster, Pennsylvania. They announced a massive $6 billion AI data center investment there.
$6 billion.
And this isn't speculative building. It is a direct client-led response to the bottleneck. They secured the committed customer demand first, ensuring that as soon as the physical infrastructure is online, that revenue immediately begins converting the $55 billion backlog.
This philosophy only building data centers, once customer demand, financing, power, and chips are all secured, is the key difference between their strategy and the speculative building of earlier cloud cycles.
It is. They are marrying guaranteed demand to physical delivery seamlessly.
It is the operational manifestation of their financial engineering. They have removed the two primary risks, utilization risk, via NVIDIA and the backlog, and now they are fighting the execution risk by taking control of the physical build-out.
That's the plan.
This brings us to the final verdict, synthesizing the investment case. CoreWeave has constructed a high-risk, high-reward narrative. The sheer size of the contracted demand, $55 billion backed by the NVIDIA guarantee, fundamentally mitigates utilization risk, which is the traditional Achilles heel of infrastructure firms.
That is the bull case in a nutshell. However, and it's a big however, the cost of achieving this scale is astronomical, meaning this company is highly sensitive to execution delays and financial structural risks that sophisticated investors must understand intimately.
Let's detail those financial structural risks, starting with the immense leverage and resulting debt service pressure.
The high level of debt is the company's primary vulnerability. We noted the $18.8 billion in total debt. This leads to massive financial service pressure. Consider this. In Q3 2025, the interest expense was approximately equal to their adjusted operating income.
So there is almost no margin for error.
None. We are looking at a high 8.7 times debt-to-EBITDA ratio. This extremely high leverage means the business is acutely sensitive to execution delays.
If they delay a single data center build by 2 quarters, the capacity isn't coming online to generate revenue, but the interest clock on the debt used to purchase the servers is ticking immediately. That's a dangerous treadmill.
It is. Any hiccup in bringing capacity online immediately impacts their ability to service that massive debt load relative to operating income. This leads directly to the second major structural risk, negative free cash flow.
The company is structurally running at a loss from a cash flow perspective, correct, because CapEx outweighs revenue recognition.
Precisely. They are GAAP unprofitable, and they run structurally negative free cash flow, or FCF, because the staggering capital expenditure required for expansion, that $1.9 billion a quarter, vastly outweighs immediate revenue recognition. The revenue is contracted, but it only hits the books when the data center is commissioned and the service is delivered.
So the long-term thesis hinges entirely on a projection that they will eventually turn on the revenue spigot faster than they are spending capital.
That is the core leap of faith. The long-term thesis depends entirely on projecting future FCF and margin increases once the need for heavy CapEx naturally declines. Management projections suggest sustained positive free cash flow is not expected until sometime after fiscal year 2027.
2027. So until then, they are dependent on continuously accessing capital.
Which means they must keep proving the viability of their SPV-backed model to the debt markets.
And we saw in Q3 that execution hiccups are real. A single third-party provider delay forced a CapEx cut, underscoring the concentration risk inherent in the physical supply chain.
It's a stark reminder that physical bottlenecks still reign supreme. While management quickly confirmed that no customers were lost and that the customer contracts are take or pay, meaning backlog revenue is locked in regardless of the delay, it emphasizes that even small delays in the physical delivery system have amplified consequences.
Because of the immense leverage and the narrow window between operating income and interest expense.
The debt service demands speed.
So CoreWeave has successfully applied high-level financial engineering, creating these bespoke debt structures amortized within the contract walls to solve the physical scaling problem that defines the AI infrastructure race. They have the technical superiority, they have the $55 billion in demand, and they have the NVIDIA insurance policy. They have, for all intents and purposes, removed utilization risk.
The essential question for the learner is this. CoreWeave has solved the problem of getting the money, and they have solved the problem of getting the chips. But in the frantic race to scale, does CoreWeave's innovative debt-fueled model represent the inevitable, successful future of specialized cloud infrastructure? Or is the immense leverage, the structural negative free cash flow until 2027, and the residual risk from that initial 67% Microsoft concentration too fragile a foundation to support their $55 billion ambition?
Risk defined, portfolio protected.